The IRS examined about 0.4% of all individual tax returns filed from 2014 through 2022. That sounds low, but that average is misleading because the IRS does not audit everyone equally. Their enforcement resources are targeted. And in 2026, they are using artificial intelligence and machine learning to decide whose return gets flagged. The IRS received $80 billion in new funding through the Inflation Reduction Act. They hired tens of thousands of new employees. An IRS Criminal Investigation identified over $10.5 billion in financial crimes in fiscal year 2025, a nearly 16% increase from the year before. Tax fraud cases alone more than doubled. But here is what should concern you as a retiree. The IRS committed to not increasing audit rates for taxpayers under $400,000 in income. That was the promise. But the IRS computers do not care about promises. They cross-reference every 1099, every W-2, every 1099-R, every SSA 1099 against what you reported. If the numbers do not match, the system flags your return automatically. No human involved, no judgment call, just a computer that noticed a discrepancy. These are the 7 red flags that are getting retirees flagged in 2026. If you trigger even one of them, you are dramatically more likely to hear from the IRS. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Kevin Retires. Every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Red flag number 1, unreported income from 1099 forms. This is the single biggest audit trigger for any taxpayer at any income level. The IRS receives copies of every 1099 form that gets sent to you, 1099-R from your IRA or 401k distributions, 1099-INT from your bank interest, 1099-DIV from your dividends, 1099-SSA from Social Security, 1099-K from payment platforms, 1099-NEC from freelance or consulting work, 1099-B from brokerage sales. The IRS matching system compares every one of those forms against your tax return. If there is a discrepancy of even a few $100s, the system generates a CP2000 notice automatically. You do not get audited in the traditional sense. You get a letter that says the IRS found income you did not report, and they have already calculated what you owe, including interest and penalties. For retirees, the most common mismatch is forgetting to report a 1099-R from a small IRA distribution, not reporting the taxable portion of Social Security benefits, or receiving a 1099-K for the first time from a platform like PayPal or Venmo after the reporting threshold dropped to $2,000 for payments made after 2025. The fix is simple. Before you file, line up every single 1099 you received and make sure every one of them is accounted for on your return. If you received a 1099 that is incorrect, do not just ignore it. Contact the issuer and request a corrected form. If you cannot get a corrected form in time, report the income as shown on the 1099 and attach an explanation. The IRS matching system does not read explanations. It reads numbers. If the numbers match, you are invisible. If they do not match, you are flagged. Let me give you a real example. You rolled over your IRA to a new custodian. The old custodian sends you a 1099-R showing the full distribution amount. You know it was a rollover, not taxable income. But if you do not report the rollover correctly on your return with the taxable amount as 0 and the rollover box checked, the IRS sees a distribution with no corresponding income on your return. A CP2000 arrives 6 months later telling you that you owe income tax on the entire amount plus penalties and interest. This happens to thousands of retirees every year. Red flag number 2, missing or incorrect required minimum distributions. The IRS knows exactly when you turn 73. They know you have a traditional IRA or 401k because the custodian reports it. And they know whether you took your required minimum distribution. If you did not take your full RMD, the penalty is 25% of the amount you failed to withdraw. Under the Secure 2.0 Act, that drops to 10% if you correct it within 2 years. But that correction does not happen automatically. You have to catch the error, take the distribution, and file the correction. Missing an RMD is one of the easiest red flags to trigger because many retirees do not realize the RMD rules have changed. The age moved from 70.5 to 72 and then to 73. Some retirees think they have more time than they do. Others forget about a small IRA they opened decades ago. The IRS does not forget. The custodian reports the account balance on December 31st every year. If no distribution is reported, the system flags it. Here is a scenario I see constantly. A retiree has 3 IRAs at different custodians. She takes her full RMD from 2 of them, but forgets about the third one, a small account with $18,000. Her RMD on that account is about $700. She misses it. The penalty at 25% is $175, not catastrophic. But the notice itself generates anxiety, paperwork, and potentially a deeper look at her return. And if she misses it for 2 or 3 years in a row, the penalties stack and the scrutiny intensifies. Check with every custodian that holds a retirement account in your name. Make a list. Verify that you took the correct RMD from each one by the deadline. If you missed one, take it immediately and file Form 5329 with the corrected amount to request the reduced 10% penalty. Red flag number 3, large Roth conversions without matching estimated payments. This is the one most people trigger without knowing. Roth conversions are legal, powerful, and increasingly popular among retirees. But a Roth conversion is a taxable event. When you convert $50,000 from a traditional IRA to a Roth, that $50,000 shows up as ordinary income on your tax return. The problem is that most retirees do the conversion, but do not adjust their withholding or make estimated payments to cover the additional tax. The IRS sees a large increase in income with no corresponding increase in tax payments. That mismatch can trigger a CP 2000 notice or, in larger cases, a full examination. Even worse, a large Roth conversion can push you into a higher tax bracket, make more of your Social Security taxable, trigger IRMA surcharges on your Medicare premiums 2 years later, and eliminate your eligibility for the $6,000 senior bonus deduction if it pushes your MAGI above $75,000. The fix is to plan the conversion with your tax advisor before you do it. Calculate the additional tax, make estimated payments to cover it, and keep the conversion amount within your current tax bracket. If your normal income is $40,000 and the top of the 12% bracket for single filers is about $50,400, you have about $10,000 of room for a Roth conversion before you jump to the 22% bracket. Converting within that space is smart. Converting $80,000 without planning is how you end up with a surprise tax bill, an IRMA surcharge, and a lost senior deduction all in the same year. Red flag number 4, large charitable deductions that are disproportionate to income. The IRS uses a scoring system called the Discriminant Information Function, or DIF. It compares your return against statistical norms for your income level. If your deductions are significantly higher than what is typical for someone with your income, your DIF score goes up and your return is more likely to be selected for examination. For retirees, this most commonly happens with charitable contributions. If you report $50,000 in income and $30,000 in charitable deductions, that ratio is going to flag your return. Even if every dollar of those donations is legitimate, the IRS wants to see documentation. Under the One Big Beautiful Bill, there's a new rule for 2026. You can only deduct charitable contributions that exceed 0.5% of your adjusted gross income. This is a change from prior law, and it reduces the amount some retirees can deduct. Make sure your preparer is applying this correctly. Keep receipts for every donation. For donations of $250 or more, you need a written acknowledgement from the charity. For non-cash donations over $5,000, you need a qualified appraisal. The better your documentation, the faster an audit gets resolved in your favor. Red flag number 5, Schedule C losses year after year. If you have a side business in retirement that consistently reports losses, the IRS may reclassify your business as a hobby. Under the hobby loss rules, you cannot deduct expenses from a hobby against your other income. The general guideline is that a business should show a profit in at least 3 out of 5 years to be considered a legitimate business. Retirees who do freelance consulting, sell items online, or run a small part-time business are particularly vulnerable to this reclassification. If you report $10,000 in Schedule C revenue and $15,000 in expenses for 3 years in a row, the IRS will want to know why you're running a business that loses money every year. The fix is to run your side business like a business. Keep separate books, maintain a dedicated bank account, document your intent to make a profit. Write a simple business plan, even if it is just 1 page. Keep records of marketing efforts, client communications, and time spent. And if you have a legitimate year with a loss, make sure you have clear records showing why. One thing most retirees do not know: if the IRS reclassifies your business as a hobby, you lose every deduction you took on Schedule C for that year, but you still owe income tax on all the revenue. So if you reported $10,000 in revenue and $15,000 in expenses, the IRS will say you owe tax on the full $10,000 with no deductions. That can be a surprise bill of $2,000 to $3,000 plus penalties. Red flag number 6, unreported foreign accounts. If you have a financial account in another country with a balance that exceeds $10,000 at any time during the year, you are required to file FinCEN Report 114, the Foreign Bank Account Report, by April 15th. The penalty for willfully failing to file an FBIR can be up to $100,000 or 50% of the account balance, whichever is greater. Many retirees who move abroad, spend winters in another country, or have family overseas maintain foreign bank accounts without realizing the reporting requirement exists. The IRS uses international data sharing agreements to identify American accounts in foreign banks. If they find an account you did not report, the penalties are severe. Even if the account earns zero interest and holds money you already pay taxes on, you still have to report it. Red flag number 7. Capital gains from selling a home without proper documentation of the exclusion. When you sell your primary residence, you can exclude up to $250,000 in capital gains if you are single, or $500,000 if married filing jointly. But you must meet the ownership test and the use test. You must have owned the home and lived in it as your primary residence for at least 2 of the last 5 years. For retirees, this becomes a red flag when they have moved out of the home before selling it. If you moved to an assisted living facility 3 years ago and the house has been sitting empty or occupied by a family member, you may not meet the 2 of 5 year use test. The IRS sees a large capital gain reported on your return and checks whether you claim the exclusion. If the dates do not support the exclusion, or if you did not provide documentation, the system flags the discrepancy. Keep your closing documents, your purchase records, proof of residency during the qualifying period, and any medical documentation if you move for health reasons. A partial exclusion may be available if the move was health-related. The partial exclusion is calculated based on the fraction of the 2-year requirement you completed. If you lived in the home for 18 months of the required 24, you can potentially claim 75% of the full exclusion. For a single filer, that would be $187,500 instead of $250,000. That still leaves significant taxable gains, but it is dramatically better than losing the exclusion entirely. I covered this topic in detail in my video on leaving your home to your children. If you have not watched that one, watch it after this video. The capital gains implications of selling a home in retirement can be $75,000 or more if you do not understand the rules. Let me bring it all together. 7 red flags that are getting retirees audited in 2026. 1. Unreported income from 1099 forms. Line up every form and verify they all appear on your return. 2. Missing or incorrect RMDs. Check with your custodian that you took the full amount by the deadline. 3. Large Roth conversions without estimated payments. Plan the conversion, calculate the tax, pay it quarterly. 4. Charitable deductions disproportionate to income. Keep receipts, written acknowledgments, and appraisals for non-cash gifts. 5. Schedule C losses year after year. Run your side business like a business or risk hobby loss reclassification. 6. Unreported foreign accounts. File FBIR by April 15th. If your foreign accounts exceed $10,000 at any time. 7. Capital gains from selling a home without meeting the 2 of 5 year residency test. Keep residency documentation and medical records if applicable. The IRS is not trying to catch retirees, but their systems do not know the difference between a tax evader and a retired teacher who made an honest mistake on Form 1040. The computers flag discrepancies. The AI identifies patterns. And the notices arrive whether you intended to make an error or not. The retirees who never hear from the IRS are the ones who report everything, document everything, and plan every major tax move before they make it. Now let me tell you what to do if you have already been flagged. If you receive a CP 2000 notice, do not panic. It is not an audit. It is a proposed adjustment. You have 30 days to respond. Read it carefully. Compare the income the IRS says you have with the 1099 forms you received. In many cases, the IRS is wrong or has incomplete information. A rollover they counted as income, a cost basis they did not include for a stock sale, a 1099-K that included personal payments that are not taxable. If you can document the error, send your response with the documentation, and the proposed adjustment gets withdrawn. If you receive a CP-14, it means you owe a balance. Pay it or set up a payment plan immediately. Every day you wait adds penalties and interest. If the amount is wrong, respond in writing with your explanation and documentation within 21 days. If you receive an LT11 or letter 1058, that is a final notice of intent to levy. The IRS is telling you they will seize your bank account, garnish your wages, or take up to 15% of your Social Security benefits. You have 30 days to request a collection due process hearing. Do not try to handle this yourself. Get a tax attorney or enrolled agent immediately. This is the one letter you cannot afford to ignore. And here is the most important thing I can tell you. Every IRS notice has a deadline printed on it. The deadline is not a suggestion. It is the date after which you lose your right to dispute, appeal, or negotiate. Open every IRS letter the day it arrives. Read the deadline. Act before it passes. That single habit protects you more than anything else in this video. This is Kevin Retires. If this video helped you, hit the like button right now. It takes 1 second and it helps this video reach more retirees who need to hear it. If you're not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. Drop a comment. Have you ever received an IRS notice? Have you been audited? Which of these red flags are you most concerned about? I read every single one, and the most common situations become future videos. I will see you in the next one.